Boy, there's lots going on in the world at the moment, isn't there? Overseas, there's all the geopolitical issues, and back home, there's our own political issues, plus concerns about inflation, about interest rates, about wages growth, and about our economy. And now that a high inflation figure has come in, there's a tsunami of predictions about what's going to happen to interest rates and how this will affect our property markets, and will this even eventually lead to a property market crash or a recession? Of course, Australia's economy and our property markets don't operate in isolation, and inflation is occurring all over the world. And that's why each month I take time out to look at the big picture, the macroeconomic factors that affect not just Australia's economy, but the world economy. And to help us understand what's ahead, I do this once a month in these big picture podcasts with Pete Wargent. While regular listeners will know Pete well, if you're new to this podcast, well, firstly, welcome. I can see there's thousands of new listeners every month. That's fantastic. But the reason I'm keen to discuss these matters with Pete is not because of his academic credentials as a chartered accountant, as a chartered secretary, or because he's got a financial planning diploma. But I enjoy these chats because of the credible perspective Pete brings on what's happening around the world. He brings that as an international investor, as a business person. And boy, has there been a lot happening since I last spoke with Pete, so I'm sure we're going to get a lot out of today's show. So welcome to this episode of the Michael Yardney podcast.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Australia's inflation rates predictably increased sharply over the March quarter to the highest level reported since the introduction of GST, when that impacted prices way back in 2000. So what does this mean for interest rates? What does it mean for our property markets and the economy in general? They're some of the many topics I'm keen to discuss in this month's Big Picture podcast with economic analyst Pete Wargent, who's a lifelong student of and commentator on the economy. Hello, Pete.
Hi, Michael. Good to be on.
Now, Pete, we really must start the discussion today with the high inflation number. The headline CPI increased by 2.1% over the quarter, giving an annual rise of 5.1%. Now, I think we've also got to declare that we're recording this just at the end of April, so it's going to come out to our listeners in probably the second week of May. And between now and then, the Reserve Bank is going to meet, and there's been lots of speculation about what inflation means. It came out higher than most of the market commentators expected, Pete.
So 2.1% for the quarter, and even the underlying measures, which strip out some of the volatility, they were also over 1% for the quarter. In fact, 1.4% for one of those analytical measures. So as you said, really strong numbers, really this, the strongest inflation we've seen in a couple of decades. There was a brief period through the financial crisis stimulus where inflation was high for a little while. So yeah, it's not something we've been really used to for quite a long time. There was a few different drivers of the inflation, as I'm sure you're about to come on to.
Sure. Well, I guess the drivers of inflation, and by inflation it means that the cost of goods and services has increased, and they put a bucket of goods and services together. But Pete, everyone knows that the cost has gone up. It's not just the petrol, even though that's come down a bit, but the cost of everything. And it's been in part related this time round, because we talked about the March quarter, to the price of fuel, and that's come down with the government incentives recently, but also the cost of house building. They were the two of the very big factors, weren't they?
Yeah, I mean, as you said, inflation is really a measurement of consumer prices, and everyone around the country would have seen it. Just going out, you go to the supermarket, there's empty shelves, you try and get a rental car or a motel, so many things have seen shortages, and the result of that is obviously rising prices. We were recently at the Gold Coast. There were just no rental cars anywhere. You could rent one for $1,500 a week if you wanted to, but that was on a minimum 4-week rental. $6,000 for a rental car. There's lots of different parts of the economy that are showing inflation. Now, the main ones that flashed up in the official statistics, as you mentioned, auto fuel was up 11% in the March quarter. The cost of dwelling construction was up nearly 6%. So haven't seen anything like that since the introduction of the GST a couple of decades ago. So a shortage of materials. There's also a bit of a shortage of labour in that sector as well. Yeah, I mean, there's real challenges in the construction sector. And the other thing people would have seen around the traps, the cost of food has been going up as well.
Hasn't it? That's right. So that's some of the factors. Interestingly, according to the factors in this basket that the Reserve Bank looks at, clothing's about the only thing that's gone down. But there's been supply constraints at the time when there was stimulus, COVID-stimulated things. And if we remember, it wasn't that long ago that, in fact, GDP fell a bit and the inflation went down a bit. So it's coming from a lowish base as well, isn't it?
Yeah, I mean, generally speaking, I suppose Australia has a relatively high cost of living because despite the COVID recession, we've really had 3 decades in Australia where the economy's just kept on growing. Generally speaking, prices are quite high. It's an interesting concept. I mean, in an efficient economy, you would think that some things would get cheaper. And in fact, as you mentioned, in real terms, things like clothing is the cheapest it's ever been. Go and buy a television, for example. I mean, I remember my parents having to save up for months to buy a television. TVs these days are relatively cheap. Lots of electronic equipment gets cheaper in real terms. But lots of stuff, sort of the essentials, things like education and healthcare, they've just consistently got much more expensive over the years. Alcohol and tobacco always gets taxed, as does fuel. Obviously, there was a huge amount of disruption over the past 2 years due to COVID. So that's disrupted all the supply chains around the world. Then governments have tipped in all this stimulus, both in terms of monetary policy, so record low interest rates, and also fiscal stimulus, all that stimulus money and programs the government's put in place to stimulate the economy. So the confluence of those two factors, the demand side and the supply side, has seen inflation take off. And they throw in the Ukraine warfare on top of that, and suddenly we've got, I hate the phrase a perfect storm, but that's effectively what it is. So we've now got lots of inflationary pressures, which everyone can see.
Well, a while ago, people were worried we were going to fall into recession. We were going to have a difficult time. What this means, to one degree, is our economy is doing okay. And part of it's on the back of all those stimuluses that have been given and the cheap money. But I guess people are wondering, well, they're more than wondering, is this now a precondition for a rate rise? What about wages growth? So let's talk about each of those initially. Everyone's suggesting, and by the time people listen to this, will know whether in May, as a lot of the people are predicting, Reserve Bank raises interest rates. If not, it seems very likely that's going to happen in June. But some people would say, Pete, hey, it already costs so much to live. It's costing more. You're telling me that. Why put up interest rates and make it even more expensive to live?
Yeah, I mean, so the theory goes, if you increase the cost of money, you reduce the demand in the economy, and that should help to bring prices down. Now, I suppose you could say, well, what use is an interest rate hike when it's things like the Ukraine war that are putting pressure on oil prices? And that would be a valid point. But that's the way monetary policy works. If you think back to 2009, which is the last time we had underlying inflation as high as we've got today, the Reserve Bank governor back then, Glenn Stevens, did hike interest rates because inflation was above target. And we'll see the same again now. The Reserve Bank has said for a long time it doesn't think interest rates will go up until 2024. But if you get inflation powering, well, it's above 5% now on the headline level. So whether it's May or June, that will be clear by the time this goes to air. But interest rates will start to go up from here. The cash rate, at the time of speaking, the cash rate target is 0.1% and inflation is 5.1%. So the real cash rate in real terms is minus 5%. So, of course, interest rates will have to go up.
So we've got wartime, so to speak, interest rates. In other words, really stimulatory interest rates. And that was done for a reason. But we don't want to overstimulate the economy. The big problem, of course, is in the past when interest rates went up, they went up too much, too fast, easy to say in retrospect. And if you look back at the 70s and the 80s when the Reserve Bank used interest rates to stop rising inflation, it led eventually to a recession. We had one in the early 80s, we had one in the early 90s, and they're talking about high rates overseas causing recessions as well. Do you think the Reserve Bank's learned anything and it may moderate interest rate rises?
Yeah, I think that interest rate hikes will be both considered and gradual. There's no incentive for the Reserve Bank to jack up interest rates so quickly that we undo all of the good work that we've seen over the past 18 months. As you said, in one sense, this is actually a really good thing. If you think back to the June quarter of 2020, inflation was actually negative. We had lockdowns, there were no vaccines, inevitably heading into recession. To see unemployment back at just a notch under 4%, that's an incredible rebound in Australia's economy. Our export prices of our coal and iron ore, they're the highest they've ever been. So nobody could have really predicted the strength of the rebound in the economy. So it's a good news story from that perspective. As you said, a lot of people will be watching nervously to see how interest rates increase from here. But it does actually reflect that employment is booming, the economy is surging back, and also population growth is starting to take off again. It's kind of inevitable that the emergency interest rates at 0.1% can't stay.
I think one of the other factors the Reserve Bank would be looking at is how the Australian dollar is faring compared to, in particular, the US dollar, because part of our economy doing well is the exporting that we're doing, and that's going to pick up particularly with the Ukraine-Russian war and more people needing our fuels, our minerals, and our food. So it's wanting to keep the Australian dollar at a particular level as well by keeping interest rates too low. That may not work in its favour.
Yeah, actually the movement in the currency is another one of the potential drivers of inflation. And recently we've seen the Aussie dollar has come down despite the record high commodity prices. The Aussie dollar has come down from 76 to 71 cents. So that actually does have an impact on inflation as well in its own right. I guess the big question that everybody's asking is this inflationary pulse, is it transitory? Is inflation going to peak somewhere around 5 or 6% and then start easing back again? In which case, yeah, the cash rate will go up, but it'll probably get to 1 or 1.5%, and that will be it. Or the other outcome, I guess, that people are wondering about is, what if inflation sticks around for a few years? In which case, interest rates will keep being ratcheted up until inflation starts behaving itself again. But when you start thinking about inflation staying at, say, 5% or higher for a few years, with the compounding effect, I mean, that is a huge amount of debt being inflated away. And of course, property investors, this is one of the reasons that property investors like real estate, because debt does tend to get inflated away over time. So it's important to remember inflation is actually a feature of the economy. It's not a bug. It's there by design.
And it's useful for people who own assets. Clearly, it's not good for people who are savers. But Australia's inflation rate currently remains well below the levels of other economies. And that's what people are looking at. They're looking over there and seeing, hey, in America, it's 8.5%. In New Zealand, it's close to 7%, as it is in Canada, the UK, just over 6%. They're wondering, are we going to get the same, or are we different? And I guess one of the other factors is it transitory? Is it all related to the COVID stimuluses in Ukraine, or is it now going to be endemic? So a number of things to think about, including what will it mean to our property markets? And I guess in my mind, if you look back at history, rising interest rates on their own did not push down property values. Last time interest rates went up, and the last few times, it took long, frequent, sustained raises in interest rates before the property market slowed down. But in those days, part of the reason interest rates went up was because of the strong property markets. This time around, our markets are, they've slowed down this year, haven't they?
Yeah, almost anticipating, I guess, the increase in mortgage rates. As you said, if you think back to the early years of the mining boom, I guess from the early 2000s through to 2008. I mean, housing prices were very strong through that period. They rose by more than 50%. But that was at a time when, because we were effectively heading for full employment and there were strong increases in wages, interest rates were going up, but the housing market performed very strongly through that period. So I think sometimes there's an oversimplification here. People say, well, lower interest rates, prices go up and vice versa. That's not necessarily how things have worked. There's markets like Perth and Darwin have had very different outcomes from Sydney and Melbourne, for example. So, yeah, look, we've got unemployment below 4%. At the last count, there was, 423,000 job vacancies. You'd look at that and say, well, that's not really a negative dynamic for housing demand. Employment's going to surge to record highs. It's heading towards 14 million. Never seen that many people employed in Australia before, and wages will start to rise as well.
So if you look at that, there's lots of factors that will cushion any fall in property values, and in some segments of the market still stimulate the market to do well. Strong employment, as you said, wages growth. And even though we're borrowing more, overall, Australians' households are in very good condition. Their wealth is higher, their net asset position is higher, and they've stashed a lot of money. They've squirreled away, well, it depends who you listen to, a record 232 billion in offset accounts, an increase of almost 15% over the last 12 months. So people have been cautious with these new times of low interest rates and know where to spend their money.
Yeah, and that's why I think a change in the cash rate from 0 to 1, I don't think it's going to really move the needle that much. The average mortgage is 24 months ahead because of, as you mentioned, people have been squirreling away money in offset accounts and redraw facilities are popular. Household savings at $500 billion, but we've never seen anything remotely that big before. So households have built up some pretty big buffers through the COVID stimulus. Yeah, I mean, some markets actually still have some momentum, places like Brisbane and Adelaide, some of the regions. Another interesting factor, I've been in Sydney quite a bit over the past few weeks, and you can see the trains are, 90% full now. CBDs are starting to get busy. So, yeah, some of the employers haven't sent their employees back into the office, notably the major banks and so on. And the reopening of the international border, well, we haven't seen the full impact of that yet, but you can see there's definitely a return to the city happening. That's another dynamic to keep an eye on.
Sure. So overall, interest rates are going to go up. Yes, we should watch it carefully, but it's no need to lose sleep over it at this point, is it, Pete?
I don't think so. I mean, if you look at, forecasters are really guessing. If you think about, what people were predicting 12 or even 6 months ago, I mean, outcomes have been so different. I mean, there's some forecasters like ANZ who think that the cash rate could get to 2% over the next 12 months, But, as you said, there's two sides to this equation. If the cash rate gets to 2%, that means the economy's still firing. So it's not all necessarily bad news, even though the media headlines love to portray it as such.
Well, it means wages will also be going up at that time because the Reserve Bank, even though they may have to wait a little while to see that happen, they're not going to keep raising rates if real wages don't go up in time as well. So rising interest rates, not always a bad sign, are they?
No, this is one of the reasons I'm somewhat sanguine about the outlook for the housing market. Of course, interest rates will go up at some point, but when you look at, wages growth over the next few years will probably be 10%. There's a tremendous shortage of rental properties. So I would say rents will go up 10 to 20% this year. Yeah, and inflation is effectively inflating away debt. So in real terms, I don't think there'll be too much of an impact on the housing market, despite what you might read in some of the doom and gloom media.
I'd like to look at a different angle of things now. An interesting blog you recently wrote about foreign buyers. Look, prior to COVID, foreign buyers were blamed for almost all sorts of things, foreign investors in property. But over the last little while, the number of foreign buyers purchasing real estate's fallen significantly, yet as we know, property values increased considerably.
This is one of the reasons I think we're heading for a rental crisis. If you remember back to 2012 or so, there was a huge number of particularly Chinese investors in the market. A lot of people looking to move money out of China. And that was what really drove the construction cycle. So Australians don't really like to buy new high-rise units. Some people do it in their super funds and so on. But actually, most Australians don't buy those sort of new, big, high-density developments. So it was all being driven by offshore money. Now, there was about $75 billion or so of non-resident purchases in residential property in around that time, but now it's fallen to another 38% over the past year, down to about 10 billion. So that's the lowest level for foreign purchases for about 15 years or so. It leads me time and again, I'm coming back to this question. We've got the very, very strong population pyramid in Australia. So there's all these young people coming into the rental market. The borders are reopening. Where's everyone going to live? I can't see it. There's no construction in the high density market that's going to absorb this. So that's why I think we're heading for a very significant undersupply of rental properties over the next year or two.
And while you can build new homes in the new estates out in the outer suburbs pretty quickly, it actually takes a much longer time, many years, to get one of those high-rise towers up in the already established suburbs or close to the CBD. You've got to find the site. You've got to get development approval. Developers have to pre-sell. They can't afford, other than if you're Harry Triguboff, to finance it yourself. You've got to find those buyers who are going to commit to off the plan. The new building standards they're going to build them better than the Opal Towers. So that's going to cost a lot more as well. It's going to be a while before we start building those to actually supply the accommodation that the new wave of renters are going to want.
Yeah, it's a really good point. The home builder stimulus that the government put in place was actually very, very successful. Over 100,000 detached homes under construction, which was the highest figure we've ever seen in Australia. But that got absorbed very quickly. I guess one of the things
and they're not going into the rental market, Pete. They're already pre-committed. So it's not new stock going to come available.
Yeah, exactly. And one of the things you do find in real estate markets is people get wealthier. And Australia's household wealth is approaching, 15 trillion. People just buy more homes and, coastal properties and holiday homes. And it's been absorbed. That's gone. The higher density developments take 2 to 3 years, usually close to 3 years to come online. So even if there was a surge now in people buying off the plan properties, we wouldn't really see the absorption starting to happen for 3 years from now. So we've got a skill shortage looming in some sectors of the economy. They're going to have to start letting people in again. So immigration's going to start ramping up, I guess, immediately after the election, the cynic in me says. But there is no rental property. There's a little bit in a city, Sydney and Melbourne, but that's getting taken up now. And lots of parts of the country have got no rentals at all. So, yeah, I mean, there are some headwinds for the property market. But again, you hike interest rates, that takes more investors out of the market and brings in more renters. Well, that's not going to help with the undersupply of rentals.
So I agree with you. We're having a rental crisis. Vacancies are the lowest I remember. If vacancies fall below 2%, rents tend to get pushed up. And in most cases, house rentals are even below 1% in most Australian capital cities and the large regional areas. And even apartment vacancies are now dropping below 2%. So, yes, in many areas, at least 10% and could well easily be 20% growth in rental. Now, people are going to suddenly say, hey, but my rent hasn't gone up. And that's because you can't instantly put up your rent. You've got to wait for the lease to expire. And the various tenancy laws say you've got to give certain notice. In the old days, when there was vacancies, you put up your rent and the tenant would find somewhere they'd move. If it was cheaper, they'd move elsewhere. They got nowhere to move now, Pete.
Yeah, I mean, the official ABS figures, they tend to lag a little bit and they're not really showing that. But if you look at the sort of more timely measures from CoreLogic, they're an SQM research and so on, they are showing double-digit increases in rents now and asking rent. So it's starting to flow through, and in some parts of the country it's chronic. And actually, we've had recently flooding in Brisbane, Gympie and Lismore, parts of New South Wales. I mean, that hasn't helped either at a time when there's already a low level of rentals on the market.
Definitely, you take a whole lot of stock out of the market. It makes it hard. Well, look, one other thing I'd like to discuss with you, again, a great blog that you'd recently written about environmental risks and something that property investors probably hadn't thought about a lot. So while investors think about risks, about vacancies, about interest rates, they actually probably haven't thought as much about the climate risks. Now, we experienced some severe floods a short while ago. I remember, in fact, people saying it was a 1 in 100-year flood, but it wasn't that long ago that I remember floods in Brisbane in 2011. We've had bushfires. I guess it's one of the factors one needs to take into account as a property investor, including the insurability of your property, because moving forward, there's going to be areas that it's either going to cost a lot more to insure or your property is going to be uninsurable.
So I guess you mentioned the 2011 floods in Brisbane then. I remember at the time there was a bit of there's talk of this being sort of a once in 50-year event, but then we've obviously more recently had more flooding in Brisbane. The general view seems to be that climate related events will become more common. They certainly get covered a lot more. I think another problem is we've often built in flood zones, and some towns like Lismore have really been hit very hard because of the sheer volume of water. There has been some market research on this. The Reserve Bank has estimated that about 3.5% of dwellings in the country could be exposed to an elevated risk from sort of climate-related events, so floods and bushfires that you mentioned. And they think that by the end of the century, that could increase to about 8%, mainly coastal suburbs, but also some inland suburbs as well. I think they've identified 250 suburbs that could be categorised as higher risk. So, yeah, look, there's something to take into account. Riverside properties, or if you're very close proximity to a beach, you've just got to be aware about things like not just flood risk, but also insurance premiums. And I guess, like, if you're thinking about the highest risk areas, then, well, it could become a self-fulfilling prophecy if people start avoiding those suburbs, and prices could go to nothing. So, I think people have usually taken into account flood risk in places like Brisbane, but maybe just need to have a bit more of a forward-thinking approach and just consider what might happen over the decades ahead.
Sure. So it's been fun chatting with you, as I do in these regular Big Picture podcasts. And before we press the record button, I was mentioning to you how much I enjoy your regular podcast as well. It comes out every Monday, and you have a wide variety of guests on the Pete Wargent podcast. So what sort of people have you been getting on, and who have you got in store?
Oh, we've had some really good guests. As you mentioned, I tried to mix it up a bit. So we have chief economists and so on, and we had Cameron Cusher from REA, but we have some different guests as well. Recently had Hoppo from Bondi Rescue, got a rapper coming on by the name of Zuby next week. So look, we mix it up a bit. There's lots of different aspects to property and financial independence. So we try to get a range of guests and viewpoints.
Okay. Well, I'll be leaving a link in the show note, but if people want to listen to your podcast, what's the name of it to find out? Because you'll be able to find it exactly where you're listening to this podcast.
Yeah, the Pete Wargent Property Pod, and you can find it the usual places, Apple, Spotify, you name it.
Yeah, well, wherever you're listening to this, it'll be there as well. And I'd recommend that because I like listening to Pete. You tell good stories, which is great. And we can always learn from other people. And similarly, you've got a daily blog with lots and lots of charts. I mean, I also follow you on Twitter. I love the things that you put out there. But if people want to get your daily blog, where do they go for that?
Pete Wargent Blogspot is the easiest place to find me. And lurking on Twitter most days as well. So pretty easy to track down.
Now, Pete, do you have one of those apps on your phone that tell you how long you've been on social media each week?
Oh, God. Yeah, I think somebody must have altered mine because it seems to come up with some very high numbers. I think it must be the kids.
It must be the kids using your phone when you're not around. Okay. Well, it'll be interesting because, again, by the time people listen to this, there will be a little bit of clarity about what's happened to interest rates in the month of May, but there's always going to be interesting news, interesting economic information. So I look forward to catching up with you again real soon. Thanks, Pete.
Always a pleasure. Thanks, Michael.
Just following on with my chat with Pete, I'd like to ask you a question. How have the last few years in the market and the economy been for you? Having spoken to lots of people, I've found we tend to fall into one of three categories. Despite all the doom and gloom, some property investors found 2020, 2021 and this year so far to be a great time, enabling them to take advantage of the opportunities the market presented. But I found there's others who found themselves in the unfortunate situation spiralling downwards financially, and sadly for some of them, things are likely to get worse. And sometimes it's out of their control because of all the things that happened with COVID. But there are also a lot of Australians who were just bunkering down, just trying to get through while experiencing the ups and downs the world kept throwing at them. And they're doing it again this year because there's so much uncertainty. But for me, the last couple of years have been a rich experience, allowing me to stress test the strategies that we use at Metropole to help our clients and ourselves and myself develop financial success. Even through the challenging times we experienced, even through the challenging times we're going to experience, we were able to fine-tune our strategies for the current times, and more importantly, it's allowed me to spend time with some of the smartest minds I've known, people who've got a long perspective, just like I've got, and we've been looking at the trends that are driving our property markets moving forward to ensure we're able to grow, protect and maintain our own wealth and that of our clients. So what lessons are you going to take from the once-in-a-generation property boom we experienced last year? Have you taken the opportunity to not just survive, but to thrive? Because the markets are changing in front of our eyes now. And now you can't just buy any property and hope it's going to work well. Remember, wealth doesn't just happen. You've got to plan for it. And in my mind, you really should be investing in your future because you're going to be spending a lot of time there, the rest of your life there. So what shifts do you need to make today to ready yourself for the markets that are changing? Like Pete and I were talking about, the markets are changing in front of our eyes. Maybe this means you've got to have a property portfolio health check to see how your investments are performing. Maybe you should be reviewing your finance strategy to ensure your structures are correct and that you can cope if interest rates rise like they're going to. Maybe you should be seeing a financial planner to ensure your money management is working for you. Or maybe you should allow my team at Metropole to build you a customised strategic property plan to ensure you know what's realistic, what's doable, what you can achieve, how to achieve your goals, how to plan to become the person you plan to become. And my team at Metropole would love to help you with this. So go to metropole.com.au and find out about our holistic strategic property planning process. Let us help you get all your ducks in a row. metropole.com.au. I hope my discussion with Pete today gave you a better perspective of what's ahead. And if you learned something and you know somebody else who'd also benefit from this type of knowledge, please tell them about the Michael Yardney podcast. You'll be doing them a favour, and to be blunt, you'll be doing me a favour in my quest to make as many people as possible financially literate. Of course, you can tell the world by leaving a review on iTunes or wherever you listen to this show. I'll be back again real soon, but you can catch me in between on social media. But a way of me saying thank you to you for listening to this podcast is I've got some bonuses. Go to podcastbonus.com.au. I'll leave a link in the show notes, podcastbonus.com.au, where you can get a heap of ebooks and reports. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael, but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?